Hello, Bitcoin friends, and welcome back to your economic calendar, the information you need to start the week off right in Bitcoin. As always, I'm Mauricio here at Ledn, and today is Wednesday, February the 1st. It's been a pretty big week already, and it's going to get even bigger. Today, we just got an interest rate decision from the Federal Reserve. We also will get interest rate decisions from the European Central Bank and the Bank of England later this week. We have some pretty big technology earnings in the US coming up that could impact Bitcoin prices as well. And we're going to touch on four big trends that could be behind the recent price action we're seeing in Bitcoin. Number one, we're going to talk about Lebanon, where people today woke up to see the value of their local currency down by 90%. We'll get into that in today's issue. In Nigeria, we're also seeing Bitcoin trade at a large premium, and that is exposing some currency woes locally. And we'll look into how you can use Bitcoin to keep your central bank honest. Third, we're going to look at liquidity in the United States economy. We are seeing liquidity has come into the market since October through the Treasury General account as well as the reverse repo facility. We're going to talk about what those two things mean and how they're impacting liquidity in markets. And last but certainly not least, we're going to talk about a project for a common currency in Latin America and why that may not be such a good idea. So, coffees, it's going to be a great one. And before we start with today's analysis, let's take a quick look at Bitcoin price action over the last week. We see that Bitcoin last week booked its fourth consecutive week of gains, rising by more than 4.5%. And it has now rallied by more than 40% since the start of the year. And just to illustrate that rally, we can see here that from the January 2nd until basically the current price, it's rallied more than 40% since the start of the year. Another positive thing that we have been seeing, if we look back to the daily, is that as we mentioned last week, the recent move had taken Bitcoin over to overbought conditions on the relative strength index, and that if we were able to stabilize around the 23,000 price, that would allow for the RSI indicators to come down within normal ranges, which would set up a healthier looking chart for potentially the next leg up. And we're actually seeing some of that during the last week. We've seen some price stability around this level, and we're seeing the RSI levels start coming down on the daily. Now, again, this sets up a healthier chart for a potential next leg up. Now, in terms of key levels of support and resistance, we see that Bitcoin continues to trade north of its 200-day moving average, which is this orange line right here, and it is currently sitting around 19,692. So 19,700 is a very key support level for Bitcoin, and it should act as support to the downside if we see a next move down, if this rally is to be sustained. Now, in terms of resistance, meaning levels important to clear on the upside, we see that the next big hurdle for Bitcoin is going to be this 200-week moving average, which is currently sitting at 24,834. Now, this will be an important level to clear if the rally is to continue. As we can see, Bitcoin has spent most of its life above this 200-week moving average, and if we get to clear up to the north side, it would set up the chart much nicer than it is right now. Now, one more thing to note is that in light of this recent rally, we have not seen a buildup of new short positions around Bitcoin. And we can pop up this Bitfinex short as a reference. Let's get rid of the RSI here. But as you can see here, Bitcoin short interest has been dropping precipitously over the last few weeks, and it is currently at near its lowest level that it's ever been. For reference, this is just on the Bitfinex exchange. So again, interest for short Bitcoin remains near its historic lows. And the fact that investors are not piling on to their new short positions at these levels could be a signal that they see limited downside left. Now, as a further reference, here at Ledn, we typically see a higher number of Bitcoin-backed loans relative to B2X loans during down or sideways markets, and a higher number of B2X loans relative to Bitcoin-backed loans in rising markets. Currently, we are seeing about an equal percentage of both Bitcoin-backed loans and B2Xs, which suggests a potential change in tides around consumer sentiment. Now, as always, we're going to dive deep into four trends that we believe are impacting the current price action you're seeing around digital assets. That first trend that we're going to talk about today is what is happening in Lebanon. Lebanese savers woke up today with 90% of their savings gone. And you're reading that right. That headline on your screen reads that Lebanon is to devalue their currency by 90% on February 1st, according to their central bank. This information, for your reference, this announcement came out on the night of the 31st of January. So it was an overnight decision that was made to eliminate 90% of the value that any saver had in that local currency stored at any local Lebanese banks. And to get into some specifics, the Central Bank of Lebanon determined that they would be changing their official exchange rate to the US dollar from 1,507 pounds per dollar to 15,000 pounds per dollar. In other words, a Lebanese person with 300,000 pounds in savings at their local bank went from having about $199 worth of savings to 20. That is a 90% reduction in the value of their savings, like that. Many of us that live or grew up in emerging economies have seen these things happen before. Venezuela did this many times when I was there, and our friends from Argentina will remember the Corralito in 2001 very well, something very similar to this happened to Argentinians in 2001. As an example, even the new rate of 15,000 pounds per dollar is only accessible to select few Lebanese citizens, likely those who are friends with or close to the government. The open market exchange rate is between Lebanese pounds and US dollars is reportedly 57,000 pounds per dollar. That's almost 4 times higher than their new updated and official exchange rate. And if history rhymes, it would not be surprising to see further increases to this official rate that they're quoting, as the central bank is forced to drive this rate that they talk about closer to the actual open market rate of 57,000 pounds per dollar. Public protests and pushbacks against these measures should also be expected. These economic circumstances should lead to much higher interest in stablecoins and cryptocurrency in the region as citizens look to opt out of a broken system, as many of us already have. The second trend we're going to talk about today is what is happening in Nigeria, and we've been covering this at length in our previous issues, but this is a very interesting update. As we covered last week, a new limit on cash withdrawals for Nigerians was imposed by the Central Bank of Nigeria last week, which prompted many Nigerians to start exploring alternatives. This led to a record increase in the search term "buy Bitcoin" for Nigeria. Not surprisingly, demand for Bitcoin in Nigeria has soared since, and so has Bitcoin's price in the local currency, the Naira. As you can see from the headline on your screen, it shows that Bitcoin price in Nigeria Naira is 60% more expensive, but that's not the whole picture, and that's what we're going to look at here today. Now, to the untrained eye, this may look like the price of Bitcoin in Nigeria is trading much higher in dollar terms relative to other parts of the world. However, to those of us that have experienced these types of currency woes, the picture is much clearer and a lot more nuanced. In Naira terms, Bitcoin was trading at around 17.8 million Nairas per Bitcoin. The Nigerian central bank claims that the Naira to US dollar exchange rate is about 460 Nairas per dollar. If both of those things were true, then that would mean Nigerians were paying an equivalent of 38,600 US dollars per Bitcoin, which is equivalent to approximately a 60% premium on the price of Bitcoin relative to the world. This formula has a problem though. That price premium is being calculated using the official exchange rate, which is far from the exchange rate most people can get on the street, and I'll explain in a second. This assumes that Nigerians can convert Nairas to US dollars freely at that 460 Naira to US dollar rate. This is not the case. Most Nigerians have to buy and sell dollars in the open market, and the exchange rate for Nairas to US dollars in that open market is close to 750 Nairas per US dollar. If we apply this 750 Naira per US dollar exchange rate to the same Bitcoin price calculation, we get that Nigerians are paying roughly $23,700 per Bitcoin, which is still a very small premium to the global price, but it's much closer to that global price that we see. And it makes a lot more sense if we look at it from that lens. Now, in summary, Bitcoin prices in local currency will expose all kinds of currency shenanigans and inefficiencies that governments and central banks try to hide. You can always calculate how honest a central bank is about their exchange rates by comparing the official exchange rate to the implied exchange rate when buying or selling Bitcoin. And now switching gears to macroeconomics, we want to talk about the third trend in the markets that is impacting prices at the moment. And that is the liquidity profile in the US economy. As we've covered here in the past, liquidity, there's a very tight correlation between the levels of liquidity in the US economy and asset prices in general. The chart you have on your screen was shared by Jurian Timmer. He works at Fidelity, and this chart tracks the S&P 500 to the overall liquidity in the United States, it being this orange line, the black line being the S&P 500. And as you can see, there is a pretty close correlation between the asset prices of financial assets like the S&P 500 and the aggregate level of liquidity in the US and or global economy. In layman terms, if central banks are injecting new cash into an economy and fostering economic activity by lowering interest rates, asset prices should move higher. And that's what we see from March 2020 until about November or December 2021. Now, if our central bank is removing cash from the system or draining liquidity from the system and rising interest rates to slow economic activity, then financial asset prices should move lower. And we saw this basically all the way throughout 2022. Now, again, this relationship is clear as water here on this chart. Now, as you can see, liquidity has been improving or did improve since March 2020, and it led to one of the greatest asset price rallies in modern history. And about a year ago today, about the end of the year of 2021, the Federal Reserve openly stated that it would start removing liquidity from the system and tightening interest rates. Since then, no surprise, we've seen markets and asset prices drop as liquidity gets removed from the system. However, if you look here at October 2022, which is about 3 or 4 months ago, you can see that liquidity did stabilize. It stopped dropping further. And so did asset prices. And this has to do a lot with the reverse repo facility and the Treasury General Account. So for context, there are 3 big drivers of liquidity in the US economy: the Federal Reserve, their balance sheet. So when the Federal Reserve buys bonds, they inject cash into the economy. And then when they sell bonds, they drain cash from the economy. So as their stock of bonds increases, this means they are injecting cash into the economy. The second source of liquidity is the reverse repo facility. And you can think of the reverse repo facility as a place where people park their excess savings to earn a risk-free return. As the reverse repo facilities balances grow, money is getting drained from the productive economy into this our reverse repo facility. As the balances from the facility fall, this means that cash is getting pulled out from this risk-free interest earning and getting injected back into the economy. So when the reverse repo balances drop, cash is coming into the economy. When it rises, cash is getting taken out of the economy. And then lastly, we have the Treasury General Account, which is basically the government's checking account. When the balances grow, it is taking cash typically from the economy via taxes or from the Federal Reserve via loans. And as the balances drop, it means that money is being spent back into the American economy. So, since October, the balances on the reverse repo facility and the Treasury General Account have both been dropping, meaning liquidity is being drained from these two facilities and put back into the economy. And let's check these numbers out. So this is the Federal Reserve's balance sheet. This one's not entirely interesting at this point. The interesting one here is the Treasury General Facility, which, as we can see here, if we go back to October, the balances on this facility have been dropping. And this is the Treasury General Account. And if we look at the reverse repo facility, we see that these balances have also been dropping since around the same time. And if we see here, the October is here, October 2022, and we see that these balances on the reverse repo facility actually went down quite significantly, meaning that there is money entering the economy from this facility as well as from the Treasury General Account. These liquidity injections have neutralized the Fed's tightening efforts for the same period and have kept liquidity stable during this period. which has greatly helped asset prices, including Bitcoin. Based on their balances, both the reverse repo facility and the Treasury General Account could continue to be sources of liquidity in the near term. And the fourth point that we're going to discuss in today's issue is the idea of a potential common currency in Latin America, which was a concept floated by the president of Argentina and Brazil last week through an op-ed. And what we're going to talk about today is whether this is actually a good idea or not. The article on your screen references the recent announcement as well as some of the commentary around it, which is somewhat consistent with what we're about to discuss. Now, in a recent op-ed, the presidents of Brazil and Argentina floated the idea of creating a common currency for Latin America. Among their stated goals were to boost economic cooperation within the countries, the member countries, and to reduce the dependency on the US dollar. This latter point seems to be a recurring trend or topic among central banks and presidents all around, this idea of reducing the dependency of the US dollar. Now, while Brazil managed to keep its interest rate, or the exchange rate rather, relatively stable over the past few years, it has recently changed governments, and the new administration does not have a great track record of exchange rate stability. Argentina's local currency and exchange rate regime is a dysfunctional disaster that we've written about here at length. So while the idea of more cooperation and less reliance on the US dollar might seem attractive on the surface, the practical implications of this regional currency could be disastrous to its citizens. Among some of the chief concerns are, number one, none of the participating central banks have a strong track record of keeping their currency stable. Number two is more centralization around a regional currency could lead to even more corruption in an already corrupt region. Number three is that there are wide economic differences between the potential participating countries, which would make it very difficult to balance roles and responsibilities within this union. And the last one is that the proposing countries are currently ruled by left-leaning governments that differ in views from the US and European governments. In fact, they are quite antagonistic. Now, in short, based on what is known today, the probability of this initiative gaining traction is low, and the probability of this ever helping citizens, even if it does go, it's also quite low based on what we know from the region today. And as always, we wrap up with a summary of what could impact Bitcoin prices for the week ahead. This week has been a pretty big one so far, and it will continue getting only bigger. We have 3 interest rate decisions from major central banks this week. We just got one earlier today from the Federal Reserve. It raised 25 basis points as it was expected. We're seeing markets celebrate that decision earlier today. Tomorrow and the following day, we'll also get interest rate decisions from the European Central Bank and the Bank of England. We're also going to get some pretty important corporate earnings. Tomorrow we get Meta and T-Mobile. Actually, today we got Meta and T-Mobile. Tomorrow we get Alphabet, or previously Google, Apple, and Amazon. And tomorrow Friday, we're going to get a read on U.S. unemployment, which again, it's on track to increase slightly from 3.5 to 3.6. We may also get some updates from the DCG and Genesis bankruptcy this week. Last week, their bankruptcy lawyers told the bankruptcy judge that they were very close to reaching an agreement with its creditors. That was supposed to happen last Friday. It did not. So it could be that we get more updates on that from this week, which could potentially impact markets. Now, with that, we have reached the end of today's show. I want to thank you once again for watching and listening and reading. If you enjoyed it, if you learned something, I welcome you to thumbs up it, like it, subscribe to our channel, share with your friends. And if you don't yet have a Ledn account, I welcome you to check us out at ledn.io and learn how you can get the best rates for any Bitcoin-backed loans. Check out products like our Bitcoin mortgage and many, many more. Thank you all. See you next week. Y los quiero mucho.